Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. One of the things that I have started doing as soon as I started investing in the stock market was to look for companies that are cheap, meaning the companies that are discounted right now, companies that have prices that are lower than their intrinsic values. What I mean by that is what Warren Buffett normally looks for basically an investment is he looks for great company at a discounted price. And early on, I started reading this book called The Intelligent Investor. And one of the things Benjamin Graham talks about is trying to find quality businesses right now that are right now undervalued for whatever reason. It could be the fact that the company had one bad quarter. It could be something else in the business. It doesn't matter what it is. You look for a quality business that fundamentally it's sound, it's good, and there's nothing wrong with the business side of things. It might just be having 1 quarter or 2 quarters or 1 year of, slowdown in the business, but in the long trajectory of the business is actually upwards and it's gonna make money. Okay, it's going to increase the revenue in the next 5 to 10 years. But people are looking at right now and what the company is going through, and they think it's all doom and gloom, and they sell it. And that gives us an opportunity. One of the companies that did this early on was Merck. This company has been in my portfolio since 2020. I think I started buying early 2020, September of 2020. I think it was the first time I actually purchased the stock in this company, right? And at the time, it was about $78 per share. And over the years, I have talked about this company, how undervalued this company was. And I kept buying. I kept, getting those dividends every single quarter. And I really didn't care what the noise was about, because I knew in the long run, okay, that people will realize how amazing this company is. And they will realize the fact that this company actually shouldn't be trading what it was trading, the price side of things. But it was a quality business, and it still is quality business. So what have I done? I kept buying more. I wish I actually bought more of this company. And as you can see right now, I am up almost to 57%, over 57%. And one of the things that I've been doing, again, I'm not saying I'm genius, but at the time I realized when I did my research, I found out this company is actually a great company in terms of from business side of things, the financially sounded business. They're one of the biggest pharmaceutical companies out there, and people were not actually pricing it correctly at the time, and that's what it was. So what did I do? I kept buying more and more every single month. I wish I bought more, and at the time it was one of my biggest holdings, so I didn't want to make it too big, okay? But because you obviously sometimes you have to do, you have to have your margin of safety. So I had to make sure that it wasn't more than 5% and so on. But as you can see right now, I own 27%, and it's up £883 right now as a profit. On top of that, I've probably been paid over £100, if not more, in dividends in the last basically 3 years. So what I'm doing right now is exactly the same thing with this company here, Medtronic. Medtronic is actually, again, very similar in terms of business model. Okay, they're in the pharmaceutical side of things, and they're going through similar sort of a phase at the moment as what basically Merck was going through in 2020. So I'm going to show you some of the reasons why I kept buying this company, and why I own right now almost over £2,000 worth of shares, right? Or 31 shares right now, and I will be adding to this company for the long run. So let me first of all show you what the company does. Okay, they basically have different segments. So 4 different segments. They have cardiovascular, which is 36% of their overall revenue in 2022. Okay, medical surgical basically was 29%, neuroscience was 28%, and diabetes was 7%. Okay, so that's the breakdown of their business, and as you can see, it's very much well diversified, those 4 different segments. And each one of these segments is obviously, the diabetes is probably just the smallest one of 7% in the 2020 earnings report that they've just released. And the products that these companies create is actually used in almost every single hospital in around the world, whether it's in the UK or America or Canada, Australia, it doesn't matter. every single one of those countries do have products that this company makes, right? And if you think about from the healthcare side of things, it doesn't matter whether we're in recession or not, because if, God forbid, you're not well today, you don't care whether we're in recession or not. You will go to the hospital. You will get your surgery if you have to have a surgery. You will get your medical if you basically have to have it. And the product this company creates is actually used on a daily basis in these hospitals. And I'm sure some of you probably work in the healthcare industry, and you've probably seen some of the products that this company creates. Unfortunately for me, one of my closest friends is actually kid has a diabetes, and I've seen some of the products that he uses actually created by this company, especially the monitoring and things like that. I don't know exactly what they're called, but those products that they use in his home is actually created by this company. So in overall, okay, I want to going through the financials now, but when you see this company and where it is in basically strategically and where we are right now in the financial, basically in the financial world, it seems very silly to actually discount completely this company. And as you can see right now, the price is $76 per share. Not long ago, I think it was $120 per share. And I was, at the time I started buying this, it was actually quite expensive, and I was trying to just a dollar cost average into it, and then the more I did it, the lower it went. EPS, as you can see right now, is $3.22, market cap of $103 billion. It has a wide economic moat, and beta is very low. So I like the fact that the beta is very low, and obviously one of the reasons I like this because it's actually is not as volatile as the rest of the market, okay? And that's, I like to have companies that have a lower beta, if you like, in my portfolio. Current PE, we're looking at about 23, but forward PE of 14, let's call it even 15, is quite very, very low for this company, because I'm going to show you in a second the average for this company. Price to free cash flow, we're looking at about 14. And when it comes to dividends, they're actually very good, 3.58% dividend yield right now. I think when I started buying it was about 2 point something. Obviously, because the price is going down right now, the dividend yield has actually increased quite a bit. Latest increase was 8%, and the 5-year growth rate is 8% as well. Dividend growth streak of 44 years. This is a dividend aristocrat going on into dividend kings very soon in the next 6 years or so. And then payout ratio only 49%. Okay, so they have room to improve that dividend if they need to. And then the safety is 99%. So there's no issues when it comes to that paying that dividend. And they have a free cash flow of $4.8 billion. So if you are a dividend investor or dividend growth investor, if you like, this is perfect, the company. Because I'm not saying go away, by the way, and buy it straight away. I'm just telling you, I'm kind of literally convincing myself to buy more of this company. That's exactly what I'm trying to do. But obviously, it's do you due diligence and do you research and so on. But when you look at 3.58 dividend yield and 8% increase every single year, hopefully, and then when you look at the growth in terms of payout ratio just only being 49% and safety 99%, that's really perfect. Because what I'm normally trying to do is buy companies who pay really good dividends, but at the same time they're increasing that dividend, but the payout ratio is quite low. Okay, because what you want them to do is to keep increasing that dividend. I don't really care as long as it's above 1%. I don't really care, because I'm not really interested in the income right now. But if they carry on increasing that dividend, that is very, very important to me, right? And they have the cash to cover that. Okay, profit margin, we're looking at about 14%. Operating margins, we're looking at about almost 19%. Return on equity, 8.2%. And total return in the last 10 years, you would have made about almost 9%. Current ratio is above 1, so they have enough to cover their current liabilities. So the next part we're going to look at is evaluation metrics, basically based on what the analyst in Yahoo Finance and Simply Wall Street, as well as Morningstar and Tiprak is actually thinking about, like I said, when it comes to this company. So next year, they're expecting about 3% growth. Okay, that's very slow for now, but the next 5 years is also again 3%. Now, this is one of the oldest companies out there. They do have a consistent revenue, but at the same time, right now, this is probably why a lot of people are not interested in this business. I'll be honest with you, I don't really care what happens in the next 5 years. Okay, I'm gonna hold on to this company because in the long run, I know with this sort of a dividend, with this sort of a cash lying around, and the type of products they sell, I have absolutely no issue in owning this company, either as an income play or growth, hopefully in the long run. So current ratio, current price, we're looking at about $76. Simply Wall Street is actually saying it's about $79 per share. Okay, that's about 1% basically undervalued at the moment. Fairly valued according to Morningstar, $112 per share is basically where they think they should be, and that's 32% discounted right now. So I do think this is more realistic. I'll be honest with you, probably 120, 150, 120 is the range that I was thinking about, but that is probably more realistic. Okay, 32% discounted right now, and according to Tip Ranks, is actually they say in the 12-month price target is $87 per share, and they expecting about 14-15% upside basically. Now they are definitely saying, Tip Ranks is actually definitely saying is hold at the moment, but in my opinion, because I own it already, I'm down a bit, I will be dollar cost averaging. And if you're interested in looking at dividend growth company and you are cool with the fact that this company might grow about 3%, 4% in the next couple of years, then obviously this is probably a good company to look at. Again, you need to do your own research and so on. In terms of revenue, this is probably why some people might not be interested in this company right now. From 30.5 to 28, so 2020 hasn't been a great year. A lot of that because of COVID situations and lockdowns. You would think because it's from basically a medical device company, they will actually benefit a lot of that. But obviously, remember, a lot of people did not go to the hospitals. A lot of surgical situations have been cancelled because of it. People were scared going to the hospital, so maybe the revenue actually didn't increase for that reason. But 2021 is actually bounced back to where it was almost a year before, and 2022 we're looking at about 32%. So right now they still obviously trailing 12 months. They only started their physical year, so I wouldn't even look at that one yet. Okay, but trailing 12 months we're looking about $30 billion, so a slight decline, and that's probably one of the reasons why some people have actually sold this company, or the fact that it's actually down quite a bit. Net income from $4.6 billion to, it went up and then came down this year, $4.3 billion of net income, and that's probably a lot to do with the costs associated with making. So the less revenue, the cost of the revenue is consistent across the board, but obviously the fact that they haven't made enough total, that has actually increased their gross profit, which then reduces their net income overall. But EBITDA from $9 billion to right now 8.77, so it's not much of a difference, to be honest with you. And the free cash flow from $5.8 billion to 4.8 billion because of COVID, coming out of COVID and so on, and now looking around $4.8 billion of free cash flow. Okay, so when you look at this, you're like, this is not the right time maybe to buy, but this is why I think I'm going to take a little bit of risk and actually add to this company right now while it's still on a discount, because I think this is a quality business. In my opinion, you might have different ideas. Okay, if this is not for you, then obviously find another company that you feel comfortable, because especially when you look around the healthcare sector, there's not that many companies right now that are trading these kind of multiples. So it is, in my opinion, it's a good buy right now. Anyway, shares are outstanding. They have diluted the shares in 2016 onwards, but they have been buying in the last, basically, just this year, they start buying it back again. So hopefully they will continue doing that in the next few years. And when it comes to Sharia compliant, so that's the last thing I'm going to show you. When it comes to Sharia compliant, there's absolutely no issues in there, and we're looking at about 100%, 23%, and 99.9%. So this 25, normally I like anything below 25%, but 23% is actually okay. But yeah, there you have it. That's the company. Again, like I said to you at the beginning, they do have so much product and it's very much diversified. For that reason, I think I'm gonna keep adding to this. Probably own about 40 shares by I don't know, mid-year 2023, and just kind of nibble here and there wherever I get the chance. I'm down about 17%. It's not a lot, to be honest with you. I'm sure it will bounce back very soon. So yeah, there you go. There you have it. That's the company that I want to talk about today. And like I said to you guys, if you're interested this company, you have to do your own research. If you're still here, just give me a like and let me know what you think about this company or any other company in the pharmaceutical company that you would basically any pharmaceutical companies that you're actually interested. Let me know. I can do a quick research on doing that. Right now I'm going through all your questions, any stock suggestions that you've made recently. I'm going to group them together and then do a video very soon. So yeah, let me know if there are any companies that you're interested, you would like me to look at, and that's it. Have a wonderful day. Assalamu Alaikum.